You're listening to the Savings Tip Jar with Dom Beattie and Denise Raywood, brought to you by Savings.com.au, your home of savings news, guides, and product comparisons. Hello, finance friends. Welcome to another episode of the Savings Tip Jar. Great to have your company for episode 162 in the jar, which is jammed full of fun finance facts, frugal finds, and fireside forums with the foremost experts in the field. There's some alliteration for you, Denise. I'm Dom Beattie, the editor of Savings.com.au, and putting up with me as usual is our senior finance journalist, Denise Raywood. And this week we'll be discussing ING's new 6% per annum savings account. What a market mover that is. We suss it out. Also, we review softer than expected new inflation data. Have we just been spared from another interest rate hike? Plus, banks behaving badly on offset accounts. The new report from ASIC identifying weaknesses around how banks are managing them to ensure customers are getting their fair share of interest savings. Good. Then, for our dollar dialogue, we talk some more about that shock new ING savings account that's offering 6% per annum with ING's head of retail, Jennifer Davies. Don't miss that chat. And of course, as usual, we'll start off with our savings tips of the week. But first, let's say g'day to Denise. G'day, Denise. How you doing?
Yeah, good, Dom. Good alliteration. It doesn't negate the lending limits that I changed a word of because as an old radio journalist, I did not like reading out loud too many letters in a row. So,
yeah, a bit of a tongue twister sometimes, but fun to say. I do like that Peter Piper pulled pepper. I won't try and say it. I try and say it really fast to my son.
Leave that one.
He starts dancing when I say it really fast. But yeah, let's get into our savings tips though. What have you got for me this week?
Well, this one is driven by the ASIC report, which we'll talk a little more about in the news roundup. But it's something that I've done myself. And the reason I did it was because I had seen something that had obviously come out of a bit of an ASIC probe that was an earlier case, and it was involving one of the big four banks as well. And it was that someone's offset account had never been linked to their home loan account. This was uncovered. There was a complaint made. And there was, even in the ASIC report that's come out now, it's very hard to say whether banks actually do this on purpose. They tend to blame their processors or individual staff members or just, failures in their systems. But actually the person was not getting any of the benefits of an offset account, which of course is there to physically take down the interest that you're paying on your loan. So I rang the bank. You might be able to do this through some banking apps, but for my particular bank, the app isn't that great. I rang the bank to actually verify that I had an offset account, which I could see was set up there, but I actually wanted to know whether that's linked to my loan account. And not only whether it's linked, but whether there's a benefit coming to me from the interest that I pay. And the bank was able to verify that for me. That was probably about a year ago. Now that this report's come out, I would urge all people to do the same. It seems like it is quite widespread and definitely worth a check.
Yeah, absolutely. When I did see this news come out, which we'll get into a bit later about the offset accounts and how banks aren't properly managing them, it did make me a bit nervous because, it's something we just kind of have to trust that our banks are doing. Like no one really has the time to be doing all the maths and ensuring that the money in the offset is properly coming out of their loan balance and resulting in X amount of interest savings. But what I do see from my lender is I get a monthly statement from them, and it tends to. It actually displays right at the top. Your offset balance started at this, and then it was this at the end of the month. And also works out how much interest you saved over that month and then also over the financial year. I've just kind of trusted that they've done their maths correctly on that, but it does give me a little bit more confidence that it must be linked, right? Then if they've got all this information on how much I'm saving, and I do kind of roughly know that it is working because I think as I mentioned in a previous podcast episode, with interest rates climbing back up to where they were, my interest rate is back up to where it was previously, but my mortgage repayment is slightly less than it used to be. And that to me is a real indicator that, even though the interest rate is back up to where it was, but the mortgage repayment is less, that means that I've effectively gotten ahead on the mortgage, and that'll be because of my offset account. So, I'm pretty confident mine is functioning, but couldn't hurt to check. For my savings tip this week, this one's kind of spurred on by that other piece of news that we'll get into, and that's that ING's shock new savings account. That one is it's a honeymoon rate. So that means it has a temporarily higher interest rate for 4 months before dropping away. And that sort of spurred on this savings tip idea, which is that if you're a diligent saver and willing to manage a bit of extra admin, then try honeymoon hopping between savings accounts. Because as we'll go into, some of the highest savings account rates on the market are indeed honeymoon rates, meaning that they have a higher rate for an introductory period, typically 4 months, before reverting to a lower rate. But if you hop between savings accounts with honeymoon rates, you can potentially maximize your interest earnings for a while. For example, over the course of a year, you might hop between 3 different savings accounts with 4-month honeymoon rates, such as ING's 6% savings booster account, Rabo's that's Rabobank. Rabo's 5.9% per annum rate. I can't remember the name of that product exactly, but that's also a 4-month intro rate of 5.9. And then Ubank's 5.85% per annum rate on their welcome rate account. And that would theoretically give your savings over that 12-month period an average interest rate of around 5.92% per annum. Now, obviously, there's a bit of admin involved with setting up each account, but I'm pretty sure these days it only takes about 5 to 10 minutes to sign up for a savings account online. But you also need to ensure you're meeting any conditions required to earn the top rate, which some of these honeymoon rates do require, such as growing the balance by a certain amount each month, and also ensuring you get the timing right so that you're transferring the money just before the honeymoon rate expires. But this extra effort could all be worth it, particularly if you have a really decent stack of savings to deposit. So, you could earn 5% per annum for little effort in a set and forget account like Macquarie's, which on a savings balance of, let's say you have a really good savings balance of $100,000, that would earn you about $5,100 over the course of a year. But if you're willing to go the extra mile to earn that 5.92%, you'd actually earn a bit over, this theoretically, a bit over $6,000. So over the course of a year, that's about $1,000 extra for that saver with a $100,000 deposit for just a bit of extra admin work that might only total maybe half an hour to an hour over the course of a year. So that's one worth keeping in mind. I've never personally tried the whole honeymoon hopping approach, but I'm sure there's plenty of diligent and keen savers out there that do that.
There definitely are, Dom. I have a look at some of these online forums and, it's a full-time job for some. It's quite eye-opening, actually.
Yes, yeah, indeed. Actually, sorry, before we get into the Savings News Roundup, something I often forget to do each episode as well is actually to read out some of the feedback or the comments that have actually been sent in. And there were a couple of savings tips that were sent in by a listener/viewer on one of our TikTok podcast clips. It was actually one of the podcast clips from our chat with Lloyd Edge, who, for those that listened to last week's episode, might have heard his savings tip, which was cut out the Uber Eats. Someone called Jonesy actually had commented on that clip saying, I already don't do Uber Eats. What are some other savings tips anyone might have? And someone with an account by the name of TWC Cam, I think that's how I'll pronounce it. He said, he or she said, write all your costs down from the largest to the smallest and work to reduce the largest ones because that's where the biggest gains are. I like that one, prioritizing your savings. And also suggested, after you've aim to lower all your costs by 10% and then invest the savings in an index ETF. So that's an interesting suggestion. We've had a few guests on this program in the past talk about index ETFs. They're basically low-cost index funds Yeah, that's with any investment, you've got to take into account all the risks and bear in mind past performance is not an indicator of future performance. Always great to get some tips sent in to us by our viewers and listeners. All right, let's get into the savings news then of the week. Denise, start us off.
Well, we've already touched on the new savings account from ING with a launch rate of 6%, which is, I think we did have a 6% interest rate sometime in the end of 2024 with a very small bank on a high balance amount. But really, we haven't seen a savings interest rate with a 6 in front since about 2013. So it is something that we should be sitting up and taking notice of. To get that rate, though, you need to be a new to ING customer. So there's a little caveat there. But yeah, it's not a bad ongoing rate once the welcome rate wears off after 4 months. 5.40%, which is pretty good. There is a requirement for that, which we'll speak to our guest about. It's definitely a new product on the market and one that sort of has become the flavour of the month, particularly with people looking for good savings products. It doesn't have too many conditions attached. It does have one, which is a balanced growth requirement of $100, not too onerous compared to some of the older products that we see on the market. So I would say that this is a direct response to the popularity of no conditions and no strings savings products, but we'll find that out from our guest.
Yeah, it's obviously not a fully unconditional product like the Macquarie one because it's, it's got the welcome rate of 6% for the first 4 months, but also the ongoing rate. It does have that one condition of you having to grow your balance by $100 or more each month, excluding interest, and that applies during the welcome period too. That you've got to meet that condition. So, but it does seem less onerous than say on the ING Savings Maximizer where there's like 3 or 4 different conditions you've got to meet, like depositing $1,000 into the transaction account that's linked and making 5 or more transactions over the month and growing the balance and keeping your balance under a certain threshold. So, this does seem a bit simpler. But yeah, like you mentioned, we are going to be talking to ING's head of retail, Jennifer Davies, about this one. So we've got a few extra questions there. So hopefully, you guys can hear that one and find out a little bit more about that account. Because it did sort of catch us off guard. It was a real surprise when we saw that one come through. And there's obviously a lot of interest in it. We've had a ton of traffic coming through to our article about that product. So yeah, stay tuned for that chat with Jennifer later on. But yes, moving on to the next big story, which has just broken in the minutes before we started recording, inflation data. So that has dropped now. According to ABS, the consumer price index rose 3.8% in the 12 months to June 2026. And the largest contributor to annual inflation was housing, which rose by 6.8%. And the next largest contributors were food and non-alcoholic beverages and recreation and culture, both rising by 3.3%. When prices for some items change significantly, measures like the trimmed mean can give more insights into how underlying inflation is trending without the impact of temporary shocks. So that's obviously the main one that the RBA cares about is the trimmed mean data. So that excludes things like automotive fuel, which has just been up and down with all the craziness of the Middle East conflict and the government excise discount, driving down prices, and then that discount being lifted and prices coming back up. So it's just like a lot of noise, and we just want to sort of blurs the numbers a little bit, and we don't know exactly what the core inflation is of the economy. So the trimmed mean is helpful with that. So yes, over the period, the trimmed mean was, bear with me, this ABS release is pretty confusing. Underlying inflation was steady at 3.6%.
That's annualized, yep.
Yeah, 3.6% in the 12 months to June. That held steady. And I think actually, if you look into the numbers, it's quite interesting because the monthly change, not to the trimmed mean, just to the headline rate, was actually negative. So we had deflation over June, but that is probably best explained by the all the fuel price craziness, because we actually had a pretty low one in May as well. It was negative 0.7%. And again, that would have been driven by the fuel price rebates. So this data has actually surprised the market on the upside, I guess you could call it. It wasn't as bad as expected. I think a lot of economists had predicted trimmed mean over the quarter would be 0.9, and it was actually 0.8, the trimmed mean quarterly number. So yeah, a little bit less than expected. So the market, the ASX 200 has lifted a little bit because it obviously lowers the chances of there being a rate hike in August. But I don't think we're totally out of the woods yet, Denise, in terms of there being a rate hike perhaps later in the year.
Yeah, we'll just have to see. But you would have to say the August meeting, the odds have gone down for a rate hike. But the year is still young, and we've still got a bit of conflict in the Middle East. I don't know what that does to how long the excise can keep hanging in there for. But yeah, you'd have to say just in the immediate meeting coming up next month, we probably are not looking at an imminent rate rise.
Yeah. Well, yeah, for me personally, that's good news then, because the home loan repayments are starting to bite quite hard. But yeah, that's just me. I know there's a lot of savers out there that maybe don't have any debt, and they're quite happy to see their savings account interest rates go up. So we try to cater for all kinds of savers, whether they're people looking to save on their mortgage or just maximise their savings on their savings accounts. The last news item, Denise, we touched on earlier a little bit, didn't we? The offset accounts.
Yeah, so a report got released by ASIC today, and ASIC's been looking into this for a while because it's been on the radar for some time. Already, ASIC said in the last 2 years, banks have paid out more than $55 million in compensation to home loan customers whose offset accounts weren't working as they were supposed to be. Funnily enough, it's all come about with ASIC reviewing offset accounts, typically how banks are setting them up, how they're managing them, and whether they're actually doing what they're supposed to do, which is saving borrowers on their mortgage interest. So they've identified weaknesses in all 8 banks that they've looked at. Some have performed worse than others. And the banks they looked at, the 3 of the big 4, Macquarie, ING, and some other top 10 home lenders. We're not talking about sort of small operators here. The biggest failure that they found, which is a bit of a worry, accounting for 55% of what they termed failures, was that the offset account was set up, but it wasn't actually linked to the loan account. So that meant borrowers were not saving any interest at all, even though they were paying diligently their money into their offset accounts. What are the other things? I think accounted for 22% of issues that they identified was that the offset account wasn't ever set up in the first place, so it never got created. There's some real worries. Other ones just were attributed to slow movement with people requesting offset accounts or changes or whatever. And these things took a long time to get going, which meant in the meantime, customers were losing out with their interest payments. Quite an interesting report. ASIC isn't too happy about the whole thing, and I'm sure the affected customers are not happy either. So as I said, now's the time to just have a bit of a check, recommended by ASIC as well. Just check with your bank, just make sure that all is in place with your offset account. It's sort of the season that you may get some compensation payouts, or banks might be a little bit scared of you ringing up or getting in touch about it. Strike while the iron's hot and just make sure all is in order, because it'd be a terrible shock to find out that, especially long-term payers of home loans, to find out that, all the things that they thought they had in place were non-existent.
Mm-hmm. Yeah, it's a bit of a scary one, that one, because as I said earlier, we really have to rely on the banks and have to put our trust in them that they are properly calculating the interest savings through an offset account, because the average person wouldn't have a clue how to work out how much they should be saving. But obviously a lot of people will be coming out jumping to conclusions that, the bank's just being greedy, trying to maximize their profits. But I wonder if it's just another case of it's called Hanlon's razor, where it's never attribute to malice or bad intent what you can attribute to incompetence, something like that.
I think the report sort of does say that.
Yeah, it's just someone just going, oh, whoops, forgot to connect that offset to that. Oopsie. The banks have, to be fair, they've paid out the $55 million, I believe, in compensation to affected customers here. So, yeah, if you're seeing a bit of extra money coming your way via your offset account or otherwise, maybe that's why, but I'm sure they would have been in touch with you about it. So they do try, these banks. I don't think they're but just whenever humans are involved, there's always going to be mistakes. Maybe that's when AI takes all our jobs, that'll be we won't have these issues anymore. But then we'll have a lot of other issues, I believe. All right, I think on that note, we'll round out the Savings News Roundup, and time to talk to our guest for our Dollar Dialogue. All right, time for our Dollar Dialogue segment. And this week we're going to talk some more about that shock new savings account product from ING that hit the market this week, the Savings Booster, which offers a market-leading rate of up to 6% per annum to new ING customers for the first 4 months, and an ongoing rate of up to 5.4%, conditional upon the balance growing at least $100, excluding interest each month. Joining us to discuss is ING Australia's Head of Retail, Jennifer Davies. G'day, Jennifer. Welcome to the Savings Tip Jar.
Hi, Dom. Thanks for having me.
Now, before we get into all the details of this new savings product that I'm sure has caused a bit of a stir in the market, let's have your savings tip, Jennifer.
Oh, thanks, Denise. And if you indulge me, I'm going to offer two to your listeners. The first one is to encourage everyone out there to log into your online banking account and check what your savings rate is and what you have to do to earn that interest. Now, my second tip is I'm a big believer in making savings as automatic as possible. So if you're able to, set up that regular transfer after payday, even if it's a small amount, and that can help savings feel a little bit more like a habit rather than something that you've got to remember each month.
Yeah, absolutely. Great tips, Jennifer, sorry. I had noticed actually in the ING app that because I have been a customer in the past, I probably should disclose that. And I did notice that it does have those little sort of tick marks next to the conditions about whether you are on track to earn the bonus interest for the month. So I wonder if many other banks offer that. So certainly logging in and making sure that you are meeting those conditions will help you ensure that you're getting the bonus rate, and certainly automating your savings, so it's just set and forget, and you're not always having to think about savings. That's a good one that a few guests have said in the past. But getting into this major product change from you guys, I think you've called it the biggest change to your savings account offering in 18 years. So I wonder, 18 years is quite a long time. So why the sudden change now?
Well, first of all, Dom, thank you for your business. It's great to hear you're an ING customer. Look, what I'll say is that customers' expectations and savings habits have been evolving over the last few years. And what we've heard is that people want products that they're easy and they fit more naturally with their what they're doing in their lives and how they manage their money. And so we designed Savings Booster in response to that feedback. It's less about reacting to a single moment and more about recognising that people save differently. So some customers, they just want that set and forget savings product, while others are comfortable taking a more active approach and being rewarded with a higher interest rate. So we thought it was time, in almost 2 decades, for us to broaden our savings range and give customers another option.
Yes, I did think it was sort of a bit of a middle path between your accelerator, which is your no conditions, and your maximizer that has a few boxes to tick there. So it did make me wonder, could could you just change one of those? What was the ethos behind the whole new product?
We look very carefully at that. And what we found is different customers, they value different things. So the Savings Accelerator, as I said earlier, that's our set and forget product that appeals to customers who just want ongoing good value without having to meet monthly requirements. And then we've got the Maximizer, which suits customers that do want to play that more active role and be rewarded with a really high bonus rate. And so rather than changing one of those two products, and potentially that would limit choice for customers, we thought it was time to introduce something new. And as you said, the booster sits in between, and it's a simple way to save built on that one straightforward monthly savings habit.
Now, Jennifer, the restriction to new customers only. We were sort of talking a bit about that around the office, trying to work out what does that exactly mean? Because, I think that restriction would be quite disappointing for a lot of the savings account aficionados in Australia who've probably all had an ING account at some point over the last few years, given you guys often have some of the highest rates in the market. So, we just wanted to clarify exactly what is a new customer.
Yeah, so to be eligible to receive our 6% introductory rate on the Savings Booster, you need to be a new to savings at ING customer. So if you're an ING customer today and you only have a transaction account or a mortgage or a credit card, for example, you'll still qualify for that 4 months period of the 6% welcome rate. Now, if you are an existing ING savings customer, provided you grow your balance by $100 each month, you'll receive our boost rate, which is currently 5.4%. And the really nice thing about the Savings Booster product is if you happen to have one of those months where you don't because of bill shock or, that holiday you've just been on, you'll still receive a 2.25% interest rate as a base. And we think that's really exciting for customers. It's something different in the market.
Yeah, that isn't too bad compared to some base rates, that's for sure. Now, I do look a lot at savings accounts products, particularly sort of popular ones, and I did notice, and I thought it's something I'll check with you, just that $1,000 monthly deposit requirement for the old Savings Maximizer. I noticed that it could be to an ING loan or even a personal loan. Is that a new thing? Was that there before?
So, Denise, we have evolved our the eligibility criteria for the Savings Maximizer over time. And you are right, exactly. It just needs to be a $1,000 transfer to a set of ING products. You pointed out a mortgage, a personal loan. There's a range of products listed on our website in the T's and C's. So there's options there for customers. And what we have done, you might have picked up on this, Denise, being a savings aficionado, we've recently taken the opportunity to update the wording about our products to make it clearer for customers on how they're able to meet the eligibility requirements.
Yes, it seems like you've perhaps extended that in a way, encompassed a few more options, put it that way.
Well, what we want to do is help more Aussies saving. That's a really important goal for us at ING, and it really goes back to our legacy in the market. And here we are, nearly 2 decades again, helping more Aussies save.
Yeah, that was well spotted by you, Denise. I would have missed that one, but that's why we have you as our top journo here at Savings.com.au. Now, Jennifer, I also want to ask, just sort of generally, I wonder if this change in offering from ING has sort of come about amid maybe depositors' preferences changing in recent years. Like, is that something you guys have noticed? Are people sort of less focused on rate and maybe are prioritizing things like having fewer conditions for earning the top rate, or cool new sort of budgeting features within an app? Is that sort of been a motivation?
Oh, look, Dom, I don't think it's an either or. Interest rates obviously remain incredibly important given the times that we're living in and cost of living challenges facing customers. But people are also looking for simplicity and convenience. And so we've heard from customers that they want to have to worry about remembering lots of requirements. And that's one of the insights that helped shape the Savings Booster. Customers told us they wanted fewer things to remember. They wanted a product that just fitted in with their natural savings habit. And so that's why we've designed the booster around that savings habit of growing your balance by $100 a month. And then, look, there are still customers who are prepared to be more active and be rewarded with earning an even higher bonus rate. And for us, that's why having options for savings is really important.
Yeah, it's interesting, isn't it, with, the success of Macquarie's no strings savings, which, tends to grow and grow still. And we saw even AMP bringing in its digital-only Go Save, and that seemed to be very popular in just its first year of being launched. Have you noticed, apart from people not wanting to think about their savings, apart from the fact that they don't need to do anything, is there anything else you've noticed with customers? Anything else that you can pick from your data?
Yeah, look, we put out a piece of research recently. We called it Our Sense of Us, and it was really important for us to understand how customers are thinking, what they're feeling, and, not just about banking, but about life in general. And a couple of interesting factoids for you. In fact, 45% of Aussies say that saving money is their number one financial goal this year, and that's increased from a couple of years ago when we last ran the research. And I think, you spoke to the range of offers that are out there in the market, and we love that. It gives customers more choice, healthy competition, and ultimately it's supporting more Aussies to save. Another thing that you might be interested in is around habits of using, different banks. And we have we've noticed that 62% of customers are using multiple banking apps for different reasons. So some customers are separating their spending and saving, or they're using different products based on their goals. And, that's becoming more normal. And it's, we encourage people to be really intentional about how they're managing their money, how they're saving, thinking really carefully about what products best meet their needs.
Yeah, it's certainly a pretty tough environment to save in at the moment, but hopefully this new product from you guys makes it just that little bit easier. It certainly can't hurt. 6% per annum for up to 4 months. And I guess we should probably thank you as well. There's been a lot of interest in this new product, and it's it's driven a lot of traffic via the article we wrote about it to Savings.com.au. So cheers for that, Jen. But most of all, thanks so much for fronting up on the Savings Tip Jar podcast and telling us all about this new product. Appreciate your insights.
Thank you for the opportunity.
Great to have you, Jen.
Happy saving. Savings is
Happy
in.
savings. Yes, that was ING Australia's Head of Retail, Jennifer Davies, rounding out another episode of the Savings Tip Jar. Thanks so much for listening. If you enjoyed this episode, please give us a follow and a 5-star rating on whatever podcast platform you're listening on, and tell your friends about us. Also, if you want to get in touch with us, whether that's to ask a question, share a tip, or give us some feedback, you're more than welcome to via any of Savings.com.au's channels, TikTok, Instagram, Facebook, LinkedIn, X, or YouTube, or shoot us an email to inquiries@savings.com.au. That's inquiries with an E for easy. We'll be back next week for more savings tips, news, reviews, and expert interviews. So until then, stay savvy. Goodbye.